So the real world rule of money for today is just understanding a couple of ratios that are referenced in the financial industry. One that is the most common, that people actually use the acronym DTI, and then the last one LTV, are some pretty common ones. The one in the middle maybe isn't the most commonly referred to in this way, or if you were to say the acronym to somebody, you know, what's your BTL, and no, that's not a sandwich of any kind with the tomato before the lettuce, but it is a ratio. So we're gonna talk about each one. So basically, the T in the middle, as we see, is the common letter, stands for to, which is meaning compared to the last letter. So the first one, DTI, stands for debt to income. So basically what that's saying, if you change the T to a divide symbol or a slash, you'd be comparing debt to income. Or what is the percentage of your debt compared to your income? So say, for example, that my debt is $1,000, and these are talking about payments, monthly payments. And so if my debt payments are $1,000, and my income, typically in a debt to income ratio, they're looking at gross income, so what somebody makes before taxes. If my gross income is $3,000, which is the I, and my debt payments are $1,000, so the D, then it would be $1,000 to $3,000, and my debt to income ratio is about 33%. 33%, because 1,000 compared to 3,000 is 33%. And so why that number becomes important is as you go throughout life and you're wanting to buy a car, you're wanting to buy a house, or you're wanting to do anything really with your credit, that is one of the things that they compare, so that your debt to income ratio really never goes over 50% total. That's going to be mortgage, cars, consumer debt. When they pull a credit report and they look at all of your debts and all of your payments and all of the things like that, they don't look at your interest rates. That's not something that credit cares about. But what they're going to be looking for is what are your total monthly debt payments compared to the income that you make. Now, as a business owner, it becomes very different, is they're not looking at gross income before salaries, before expenses, before deductions, before all that stuff. It's a totally different approach when it comes to debt to income ratios. The second one is something that matters a lot when it comes to improving your credit, and that is your balance to limit ratio on any consumer revolving debt. And so, for example, if I have a credit card that has a limit, which is the L, a limit of $10,000, and my balance is $10,000, that does not help my credit, where I'm totally maxed out. Okay, that actually starts to hurt my credit. If on that same credit card I owed $5,000 and the limit is $10,000, then my balance to limit ratio is 50%. Now 50% starts to help your credit, where if I can get that balance to limit ratio down to 30 or 33%, it starts actually creating an excellent credit rating for me. So some things that we've done for clients, and this is kind of jumping ahead into giving some real world application of this rule, is let's say I had that credit card. Let's go back to my first example where I owe $10,000 on a card that has a $10,000 limit, and that's hurting my credit. If I was to go and open another credit card and do a balance transfer where I transfer half of the balance, so 50% or $5,000, to the new card that also has a $10,000 limit, now I'm at 50% on both. I still have the same debt, but it actually helps my credit. If I and people are like, no, it wouldn't help your credit because now you've got two cards open, instead of 1. Well, that's a great opinion, but that's not how it works. It will help your credit by getting that second one, $10,000 limit, transfer $5,000. The only danger in that is now instead of only having access to $10,000 limit on credit cards, this person has now $20,000 they can access. And so discipline definitely plays a factor in this. But if someone was to take that same example, $10,000 that they owed on a card that had a $10,000 limit, and they opened 2 more credit cards with $10,000 limits and left $3,333 on the first one, transferred $3,333 to card number 2, and transferred $3,333 to card number 3, even though they have 3 lines of credit open. And of course, this is all looking at if they can qualify for those types of balances on a card. That would actually start to put them in an excellent credit rating as they make the payments to all 3. So that is what is determined, and I don't know if this is a real thing that people, talk about this ratio in this way that we do sometimes, but balance to limit ratio there in the middle. And that's going to be the same with a home equity line of credit. It's going to be the same with any sort of open line of credit, credit card, etc. So last one, LTV, and that is loan to value. And so if somebody has something of value, a loan that's collateralized in some way, like a house or a car, is they're looking at the total loan that you have. So let's say I'm going to buy a house for $100,000, which you can't find, by the way, in 2018. But just to keep our numbers easy, the value of the home, the V value, is $100,000. If the loan that I get is for $80,000, that is an 80% LTV. 80% loan compared to the value. 80% LTV. Okay, there are in some cases places or cars, for example, where we can do 100% financing. So when they say 100% financing or up to 80% financing or up to 87 or 97% financing, the LTV is what they're talking about. And so if the highest that they'll do is a 96.5% LTV, then the other 3.5% has to be a down payment or come up with from somewhere else. And so if this is something to learn for yourselves, for friends, family, that these little things can be shared with people, but it also kind of gives you a few little talking points or being able to speak the lingo of loan officers and bankers when, if you just reference, especially the top and the bottom acronyms where it's just, my DTI is this and what's the LTV, and it's just starting to speak the language of money. So that is our real world rule of money for today, ratios, specifically talking about debt to income, balance to limit, and loan to value.